Good morning, everyone, and welcome to the RSM JobKeeper payment scheme update. My name's Andrew Sykes. I'm a director with RSM in our business advisory area. Today, I'll be joined for the webinar by Sam Mohammad, Director of Indirect Taxes for RSM, Will Laird, the Director of Business Advisory, and Tracy Dunn, Associate Director in Tax. During our webinar today, we are going to go over some of the key concepts of the JobKeeper payment scheme. We're going to have a look at the employer eligibility, employee eligibility, and interaction with other taxes. We'll also touch on the record keeping and risk management and the next steps that you need to take to enrol for JobKeeper. There's plenty of complex information in this webinar. I'd like to let you know that you can keep up to date with all of it at the RSM coronavirus site. It's rsm.com.au/coronavirus. All the materials are on there are free, and we've done an updated report on all areas of the stimulus. You can download that. Also, at the end of the session, we'll have a Q&A. Feel free to answer or enter any questions, and we'll answer them as we go, and we'll also have detailed Q&A at the end of it. So I'll hand you over to Sam now, who will start the presentation on the JobKeeper scheme.
Yeah, thanks, Andrew. Before we kind of kick off into the JobKeeper scheme itself, I just wanted to maybe make reference to the RSM response framework. And where this kind of sits in, where the JobKeeper scheme sits in our framework. So if you're looking across the framework itself, and this is available from the resource centre that Andrew mentioned, but towards the bottom left is the box that says access available government stimulus funding, and that's really where the JobKeeper scheme sits. So it's really at this stage about getting immediate cash in the door from the government on the basis that this is a very short-term measure. And then obviously more into the long term, what you're looking to do in terms of your business is to repair the damage, obviously, to your balance sheet, but also look to strengthen and refine your business. So in terms of an overview of the JobKeeper program, an awful lot has happened in a very short period of time. So it's worthwhile just providing a bit of a recap. And I do suspect that there's still a long way to go in terms of getting some clarification on a few key points. I have to admit that trying to pack all of this into about 40 to 45 minutes is a bit of a challenge. So if I do miss anything, and if there's an area that you're really interested in, do use that chat function that Andrew mentioned. As I'm sure most people are aware now, the JobKeeper scheme itself is a $130 billion scheme designed to help employers subsidise the cost of retaining employees. And the flip side of that is that it's designed to keep that connection between employees and employers, which it will be so vital when, as the Prime Minister says, we snap back into normal, or whatever the new normal looks like once we get past this virus. The JobKeeper program itself will be administered by the ATO and operated using the existing tax and single touch payroll systems. So while the ATO is to be commended with the speed with which it's put out its guidance and made the application forms available, it is fair to say that there's still a lot of gaps, both in terms of knowledge and understanding. What we do know is that the JobKeeper scheme will run for a maximum of 6 months, and the payments from the government will be accessible for income tax. They won't be subject to GST, and nor will the JobKeeper amounts form part of your turnover. In terms of eligibility, businesses and not-for-profits will have to show that they are carrying on a business in Australia and that their turnover has declined by a sufficient percentage relevant to a prior period. Once you satisfy the eligibility criteria once and you enrol in the program, you're eligible for the rest of the program, so you don't need to keep reassessing. There's essentially a two-part process though. You have to enrol once for the program, and you have to apply each month for payments for each eligible employee and for each JobKeeper fortnight within that month. It's $1,500 per eligible employee each fortnight, and it's paid monthly in arrears to the employer. So there's a real question here for employers in terms of how are they actually going to fund the cash that they need to make and they need to pay to employees in terms of their necessary wage payments. It's interesting that this issue has actually been getting a lot of press recently as we're getting towards the end of April, and employers are having to make that decision as to whether that they try and fit within the scheme or perhaps they sit April out. This is a really critical and practical issue for employers, especially if the $1,500 minimum per fortnight payment to an employee is actually higher than the usual wage for the employee. So given this is intended to be a pass-through payment from government to employer, ultimately to the employee, it goes without saying that employers cannot retain any of the $1,500. It is not designed as a windfall gain to employers. It must be passed on to the employee or for the benefit of the employee in full, but it may not necessarily be in cash. So that's the point we'll cover in one of the later slides. A point which the ATO has clarified in recent days is that this is a one-in, all-in scheme, which means that employers, that once an employer has elected into the scheme, the employer must nominate all eligible employees, and it cannot pick and choose which employees it seeks to nominate. Finally, many of the rules are designed around ensuring there is no windfall gain in terms of employees who are already accessing government-funded subsidies. So these subsidies are, say, paid parental leave or workers' compensation payments. While we talk about the JobKeeper program as being a 6-month scheme, it's probably more correct to call it a 13-fortnight program because the eligibility for payments are based on a fortnightly basis. The first fortnight starts on the 30th of March, and there are 2 JobKeeper fortnights per month, other than August, which has 3. Payments are made on a monthly basis in arrears on the 14th of the following month. So for instance, in the month of August, you'd need to be paid by the 2nd of August to be eligible for fortnight 9, but you won't actually receive the payment for that until the 14th of September. With this next slide, what we wanted to do was really just to help clients visualize what the JobKeeper program means in terms of actual dollars coming into the door. So say, for instance, you had 1 employee, across the life of the scheme, what you'd be receiving from the government is $19,500. But if you had 1,000 employees who were eligible for the scheme all the way through, you're looking at a payment from the government across the life of the scheme of $19.5 million. Now, there's obviously an assumption here that every employee is eligible and you've met all of the criteria that you need to meet. But what we're trying to do here, and what's hopefully obvious, is that we're talking about substantial amounts of money from the government coming in a very short period of time. So fundamental to accessing the JobKeeper scheme, a business has to be an eligible entity, and it can qualify in one of 2 ways. Firstly, it can qualify through having paid employees, and secondly, it can qualify through what we call business participation. On the other hand, ACNC registered charities and other not-for-profits may only qualify through that first paid employees criteria. Some of the threshold requirements are listed on the slide. Now, most of these are fairly self-explanatory, so I won't go through all of them, but I just wanted to flag a couple that are really important. So firstly, not only is there a requirement for the entity to be carrying on a business, but that business has to be in Australia. And when we're talking about not-for-profits, we're talking about not-for-profits that are carrying on their objectives in Australia. So there's already a significant commentary in terms of these concepts, but it's important to think about them when you have entities which are more passive, say investment companies. Secondly, and one we'll look at in a bit more detail, is that you have to meet a decline in turnover test. So this will be a minimum 15%, 30%, or 50% decline in turnover, depending on the type of entity that we're dealing with, as well as the turnover of the entity. And we'll also go through the 1 March conditions and some of the record keeping requirements later in this session. So looking at the entitlement based on paid employees, the table provides quite a lot of detail, and in the interest of time, we're not really going to go through each of the elements. But what I want to do is really just flag a couple of things. First, you must meet the test set out on the right-hand side of the table by the end of the relevant JobKeeper fortnight to be eligible for payment for an eligible employee. The flip side of this is that if an entity fails to meet the test at the end of that fortnight, they're not eligible for payment for that employee for that fortnight and would then have to wait until the next fortnight to consider eligibility. You must meet the wage condition test for each fortnight to be eligible for a JobKeeper for that employee. Essentially, that wage condition is that the employer must pay the employee at least $1,500 per fortnight before tax to be eligible. This is a black and white test. So anything less than $1,500 for that employee, you get nothing. But once you reach or exceed that $1,500 for that employee, you've then met the wage condition. Finally, employers must elect to participate in the scheme through an online enrolment process, which opened up on Monday. To be eligible for the first 2 fortnights, the enrolment form must have been completed by 30th of April. As I mentioned, the second way that an employer can be eligible is based on what's called business participation. Now, this is designed for those businesses like sole traders and partnerships where the owner and operator of the business may self-employ themselves as part of the business, but not necessarily pay themselves a wage. As you'll see, it's very similar to the one slide we had previously, which was around paid employees. The exception here is that the individual that we're talking about is not an employee. However, they are an individual who is actively engaged in the business. And the other point to note about this eligibility test is it's not available for not-for-profits. So just on the non-individual employee point, only one individual per entity can obtain this payment, and that individual cannot be an employee. The table on the slide provides the requirement for each entity type and also that the individual must be 16 years of age or older, except when we're talking about trusts where the beneficiary has to be 18 or older. They must also be an Australian resident. Further, the individual cannot be a business participant for another entity and they can't be an employee of another entity. So an interesting point with a JobKeeper payment made in respect of a business participant is that the JobKeeper payment is made to the entity, but unlike when we talked about it being in respect of paid employees, there's no requirement in this eligibility test for that JobKeeper payment to actually be passed through to the individual. Finally, there's also an active business integrity rule. So the requirements of this are set out on the slide. Essentially, the business can't be what the ATO calls a pop-up business, which is really just a business that has been created very recently for the purposes of accessing the JobKeeper payments. Instead, a business must have had an ABN as of the 12th of March and on or before that date must have lodged its 2019 tax return showing assessable business income or lodged a BAS after 1 July 2018 showing taxable GST-free or input tax supplies. So again, this criteria is really designed to show that the business that we're talking about is not what the ATO calls a pop-up business. One of the more critical issues with the JobKeeper scheme is the decline in turnover test. And I have to admit, this is an area of the JobKeeper scheme that has raised a lot of questions. And a lot of the reason why the questions are arising is because there are essentially 2 types of turnover tests inbuilt into the decline in turnover test. One is based on income tax concepts and one is based on GST concepts. So we'll go through that as well as stepping through the ATO's 5-step process. So for those who've seen it, the ATO has set out a guideline, and for the basic decline in turnover test, which we'll go through now, the ATO has set out a 5-step process, which I have to admit is actually quite a good guideline to follow. Now, the reason why this decline in turnover test is so important and so critical is because you've really got a good handle on what the tests are, how to apply them, when to apply them, who to apply them to, and finally, how to evidence them. If we turn to the first step, that's really about identifying your turnover test period, which is the period in 2020 that you're using to show the decline in turnover. There are effectively 9 test periods that you can use in order to access the JobKeeper payments. Now, these 9 test periods are the 7 calendar months between March 2020 and September 2020. Plus, there's also the 2 quarters of April to June 2020 and July to September 2020. Now, as I mentioned, there are 13 JobKeeper fortnights spread across the next 6 months starting from the 30th of March. Since you can only be eligible to receive JobKeeper payments for a fortnight if you pass the decline in turnover test by the end of that fortnight, an entity wishing to be eligible for all 13 JobKeeper fortnights needs to satisfy one of the 3 periods which starts on or before the 1st of April. So they're the 3 that I've highlighted of March 2020, April 2020, and the quarter of April to June 2020. One really important point to note here is that the Commissioner's guidance has clarified that you don't have to choose a monthly test period if you have monthly BASs, and vice versa, you don't have to pick quarterly periods if you have quarterly BASs. Instead, any entity can choose any period. So say, for instance, you've got an entity that lodges quarterly BASs, it could choose a test period for the month of April 2020. While choosing a test period that doesn't match your natural GST reporting period will add a layer of complexity, because quite often your accounting systems aren't designed to make the distinction in terms of exactly when your sale needs to be put into which month. But doing this could actually be beneficial and make you eligible for the JobKeeper scheme earlier than you would have if you followed your BAS period. So say, for instance, you're a quarterly BAS lodger. You might have had a terrible March 2020, but your June 2020 BAS, quarter BAS isn't looking too bad. So if you followed your natural reporting period and just looked to the June quarter, you may not satisfy the JobKeeper requirements or the decline in turnover test. But if you looked at just the March 2020 month as a quarterly BAS lodger, if you met the decline in turnover test, you would be eligible for JobKeeper from day 1. So by choosing a monthly test period, you're potentially able to access JobKeeper quicker than if you had stuck with your quarterly June quarter. So the last point I want to note from the slide is that once you've chosen your turnover test period, you have to identify your relevant comparison period as step 2. So that's pretty straightforward. As the slide suggests, when you're looking at the basic test, it's just the corresponding month or quarter from 2019. So looking at what you include in turnover for GST purposes, when you're looking at the turnover test for 2020, other than March 2020, which is now already passed, and you can use actual figures for, all of the turnover test periods are based on projected GST turnover for that period. So say you're wanting to test the month of April 2020, which is what we're in. What would you include? Well, what you'd include would be all of the taxable supplies you've already made to date, so from the 1st of April through the 24th of April. Then you look at what taxable supplies you're likely to be making between now and the end of the month. So for the next 6 or so days. And the word likely here just takes its natural and ordinary meaning. So it's really just about what on balance of probabilities, what do you think will happen? So you've added in your taxable supplies, obviously excluding the GST amount itself. Do the same for GST-free supplies. So look at the GST-free supplies you've made between the 1st and 21st of April. Look at what GST-free supplies you're likely to make between now and the end of the month and add those together. Now that itself is the basic turnover tests as they currently exist. What the JobKeeper program has done is modify that projected turnover test slightly. So the main one that you need to be concerned about is if you're a member of a GST group, you have to actually add in the GST exclusive values of all supplies made or likely to be made in that test period to other members of the GST group. So this will be a really important one to note, as usually for GST purposes, supplies between members of a GST group are ignored and don't count as part of turnover. If the entity is an ACNC registered charity or deductible gift recipient, you also need to add in the value of all gifts. So usually gifts are excluded from turnover since by definition, they're supplies for no consideration. The reason for adding this in is a bit of a concession to charities and deductible gift recipients, because the feeling is that donations will reduce as the impact of COVID-19 hits. So by allowing you to show the decline in donations that are coming through and have those form part of your turnover, you're able to then show your turnover has also declined. What is also excluded are all input tax supplies, such as interest, loans, and dealings in shares. Also excluded are supplies for no consideration, supplies not made part of an entity's enterprise. And the two that are quite often overlooked, but could be very relevant in this environment, are the last two. So supplies of capital assets and supplies made as a consequence of substantially or permanently reducing the size of the enterprise. So on that last point, say you had a business that operated 10 stores, but because of the downturn, the owner had to sell off one of those stores. What this exclusion does is exclude from projected GST turnover the value of the sale of that one store, or the value of the sale of the assets from that one store that you're getting rid of. And that could make a very favourable difference to the calculation. Again, what you're trying to do in your projected turnover for the month of April 2020 is to get that number as low as possible. So by excluding substantial sales in respect of a capital asset, it will help with the calculation. So with the current turnover for the same period in 2019, it's essentially the same test, other than the fact that you're not using projections, you're actually using historic numbers. The other thing to remember is when you're looking at current GST turnover, you don't exclude your sales of capital assets and the assets that were substantially and permanently reduced in size. 3 points I want to stress here. The projected turnover test is partly or fully based on reasonable projection and forecasts at the time that the projections are made. So these projections, as long as they're reasonable when they're made, don't get reviewed with the benefit of hindsight. However, as the Commissioner notes in that GST ruling, GSTR 2001-7, you have to have reasonable evidence such as business plan, forecast, management accounts, buyer's assumptions as support. And what you also need to ensure is that you don't have any contradictory evidence that suggests that the turnover that you're using for GST purposes may not in fact be reasonable. So say your management accounts are showing a different estimation around revenue, that's unlikely to be helpful. Now, because of the modifications and that periods won't always match your BAS periods, your current and projected turnovers may not match your BAS, and that's okay. What's important is for you to have documented your actual turnover calculation. Finally, the Commissioner has stated that entities on a cash basis of reporting can use an accruals basis for determining their projected GST turnover. So they have a choice between cash or accruals when looking at the test period. However, those already on an accruals basis have to continue using an accruals basis for their GST turnover. So moving on to the last couple of steps, these are generally going to be very easy and mechanical steps, or hopefully fairly easy. Step 4 is to work out the aggregated turnover to determine which of the 15%, 30%, or 50% decline in turnover you need. So the definition of aggregated turnover refers to income tax concepts, and it refers to the ordinary income of both the entity and its related and connected entities, such as subsidiary companies and head companies. So you're looking at the ordinary business income for the entity and its related entities, and if that amount for either the prior income year or the current year is or likely to be over $1 billion, the decline in turnover between your 2020 period and your comparison 2019 period needs to be at least 50%. For all other entities where the aggregated turnover is below $1 billion, the required decline in turnover is 30%. There is also a special rate of 15% that applies to ACNC registered charities. So ACNC registered schools and universities are excluded from the 15% rate, and they otherwise fall within that 30% or 50% decline as relevant. And to step 5, that is to apply the actual decline in turnover that you've calculated back to what your required decline in turnover is or needs to be. So if it meets or exceeds it, then you're eligible for JobKeeper for the start of the period onwards. You'll see on the slide, I've extracted from the Commissioner's guidance an example. Now, without needing to step through that example in a lot of detail, it essentially shows that Fluffyco and Puppyco are connected entities, and therefore their aggregated turnover is the sum of their two individual turnovers. So the 950 plus the 100 That takes them over $1 billion, which means that the required decline in turnover is 50%. PuppyCo has declined by only 10%. FluffyCo has declined by 50%, and therefore FluffyCo is ineligible, but PuppyCo is not. PuppyCo would need to test for another turnover period other than May to determine if it is eligible for the JobKeeper scheme. Now, the last item I wanted to cover are the alternative tests. These were only released yesterday afternoon, so they're still very fresh, and I think everyone's still trying to grapple with how they might apply in practice. Appreciate there's a lot of detail on the slides, but in order to kind of get the information out there, this was as good as I could do in the limited time that I had. So the basic test obviously presumes that the entity in question was in existence this time last year. The basic test also presumes a number of other things, such as the business that existed last year was the same type, the same size, had the same assets, and that there was a level of continuity and there's little variance year on year. Now, all of those presumptions don't otherwise match reality for some businesses. And so what that means is it makes the basic test inappropriate or unfair in some circumstances. So to deal with this, the Commissioner has issued 7 alternative tests to deal with a number of these scenarios. To go through them, the first 2 tests can apply where the entity in question wasn't operating a business a year ago and therefore doesn't actually have a comparison period from 2019. Instead, such entities have a choice of 2 comparison periods they can compare to their 2020 test period. Either they can compare the average monthly turnover since the entity commenced business, or they can compare the average monthly turnover for the last 3 months prior to the test period. So say, for example, you were testing April 2020. Using this test, this last test, you'd compare the April 2020 projected GST turnover against the average turnover for the months of January, February, and March 2020 to see if the required decline in turnover was present. With the next alternative, where the entity has undertaken material change to the business through disposals, acquisitions, and restructure, the comparison period that you'd use would be the first month after the M&A activity occurred, or if there was multiple M&A activities, the first month after the last acquisition. Where the entity's turnover was growing substantially, in this case growing by 50% in the 12 months leading into the test period, you would use the average turnover of the last 3 months prior to the test period. So similar to the earlier example, if you're testing April 2020, you'd be using the monthly average of January, February, and March 2020 to test against April. So the 5th alternative test, if the comparison period in 2019 was materially affected by drought or other disasters, you'd be entitled to use the corresponding period in 2018. So again, if you're looking at April 2020, the comparison period, if 2019 was drought affected, you'd be reverting back to the turnover from April 2018. Alternative test 6 is primarily designed for builders and developers, but may apply to any entity with irregular and non-seasonal income. So where there are large and irregular variances in its income, it's entitled to use the monthly average of the 12 months prior to the test period. As the slide states, this test is designed for those entities where the turnover is irregular rather than where the turnover is just seasonal. So the Commissioner's expectation is that where your turnover is seasonal, your corresponding period in 2019 would generally be reasonable, be a reasonable comparison period, and that's why the basic test should still apply to you. Finally, and perhaps more of a niche test, if the entity involved is a sole trader or a small partnership, and the sole trader or partner was not working due to leave, illness, or injury, you may be entitled to use the month that follows the one in which they return to work. So just a few things to note with these alternative tests. They are not discretion, so you don't need to apply to the Commissioner to use them. They are, as the name suggests, alternatives to the basic test. So you essentially self-assess your eligibility and ensure you document why you're eligible. You only need to satisfy either of the basic test or just one of the alternative tests. So you don't necessarily need to test the basic test if one of the alternative tests would otherwise apply. And for those who've read the RSM summary of the alternative tests, you'll note that there's a sense of disappointment amongst a lot of us advisors on behalf of our clients that the Commissioner has chosen not at this stage to issue a test covering service entities. The Commissioner's tests all seem to presume that the entity which operates the business to the public is the entity which employs all of the staff. Now, as we know, that's not the case for many groups, which typically have an employer entity which then provides services to the business entity. So while the business entity may have suffered a substantial decline in turnover due to its sales falling off a cliff, the employer entity still has the same or similar revenue because its revenue is effectively just a recharge of its wages plus a small markup. And that on charge may not have changed too much. So in this slide 20, what I've extracted is an example from the Commissioner's alternative test, just to demonstrate it in action. So this one sets out an example of a new business which was not in existence as at the comparison period in 2019. So you'll see in the example below that the second alternative test has been applied, such that the monthly average of the last 3 months, being January, February, and March 2020, so that gives you an average turnover for each month of $3 million, is then applied against the April turnover figure of 1 million, which shows a sufficient decline against the required decline of 30%. So they would be eligible in this case. So I'm going to move away from the decline in turnover and the employer side, and we'll switch our focus over to the employee side. So this is a fundamental part of the JobKeeper scheme. So after you've determined that you're an eligible employer and you've met the decline in turnover test, the next step is to identify those employees who will be eligible. So the basic tests for employee eligibility are determined as of 1 March 2020, and they are: so the employee needed to have been a full-time or part-time employee as of 1 March 2020. They needed to have been a long-term casual and not a permanent employee of another employer. They need to have been at least 16 years of age, and they need to have been an Australian resident and citizen, or the holder of a permanent visa or protected special visa holder, or an Australian resident and the holder of a subclass 444 visa. The other requirements are that the employee needs to have been employed by you at some time during the relevant JobKeeper fortnight, including those stood down or rehired. They need to agree to be nominated by you and not be nominated by any other employer, and they must have been paid the minimum $1,500 per fortnight. So turning now to some of the issues we've seen with our clients that they've had to consider on the employee eligibility side, there's obviously the age-old issue around determining residency. The residency tests can be a bit vague, and they're very fact-specific. So I understand there's also an additional layer of complexity for those on subclass 444 visas who are from New Zealand and may be entitled to this visa on arrival into Australia. The difficulty for them is determining that they're actually Australian tax residents. The definition of long-term employee is taken to have its meaning for Fair Work Act purposes. However, this fails to have regard to the fact that this definition itself is not overly clear. So we'd recommend that any client who's struggling with this definition should seek their own employment law advice, as it may not be obvious in every case. Where an employee has one or more multiple employers, the employee can nominate any employer, provided that the employer is an eligible employer. However, where an employee is a long-term casual for one employer, but a permanent employee for another employer, they have to nominate their permanent employer. Finally, as we've discussed a few times, the employee must receive a minimum of $1,500 a fortnight. However, it's important to note that this $1,500 per fortnight can be satisfied through a range of means, such as wages, PAYG withholding, fringe benefits, and salary sacrifice payments. One final thing to note is that if an employee is ordinarily paid less than $1,500 per fortnight and must be topped up an amount to get them to the $1,500, the amount of the top up only is not subject to superannuation. However, and to reiterate, their usual time earnings of say $1,000 would be subject to super, but any top up to get them to the 1,500, so the 500, would not be subject to super. Turning briefly to how JobKeeper payments may interact with other employment tax obligation, and this slide is current as of today. JobKeeper payments, when passed through the employee, are likely to be considered taxable wages for state and territory payroll tax purposes. The exceptions to this are Western Australia, which has already legislated an exemption. That exemption applies to the first $1,500 paid to an eligible employee, but not for the amount above the $1,500, which will still remain subject to payroll tax. And South Australia, which has announced an exemption, but that's not been legislated yet. Now, obviously, it'd be ideal if the other states joined Western Australia and hopefully South Australia in the payroll tax exemption, so that there's a level of harmonisation, but we've not seen that announced or legislated yet. In relation to workers' comp, the current view is that JobKeeper payments are likely to be seen as wages and subject to workers' compensation premiums. Again, we're hopeful that there's a specific exemption applied in each state, but so far we've not really heard anything. The sum total of all of this is that from an employer's perspective, the pass-through of the JobKeeper payments does have some real costs attached to it. So potentially in the vicinity of, say, 5 to 6% in terms of direct on costs as a result of state taxes. Just to briefly cover off on the record keeping requirements, there are very broad integrity and anti-avoidance measures built into the law, so to capture anyone that seeks to manipulate their fares for the sole or dominant purpose of accessing the JobKeeper scheme. In addition, there are hefty penalties and interest that may apply, so the very simple message is to really think through the logic and reasoning of anyone doing anything along the lines of holding back your billing cycle or standing down all of your employees for a significant length of time, even when there's work available. Employers just will have to manage the expectations of the public and employees if an employer chooses not to participate in the scheme, even if they might be eligible. And we've seen that play out in recent media reports where small businesses are bearing the brunt of disgruntled employees simply because the small business doesn't have the cash flow to cover the fortnightly payments. Finally, there's a requirement to retain sufficient evidence and essentially a defence file to evidence a number of the matters relevant to JobKeeper payments, such as the turnover calculations and identifying eligible employees. In terms of next steps, the ATO itself has put out a lot of guidance around JobKeeper. But what you're seeing on the screen is the ATO's suggested step plan as it stood earlier this week. It's a pretty reasonable guide, so given time, I'll leave that to each of you to read through at your leisure. I'll also note that the enrolment form is also live. There were a few bugs in it earlier this week, particularly in respect of business participation. If you were trying to nominate a business owner, the system wasn't allowing you to do that, or if you were trying to use the June quarter as your test period. I understand they've been fixed. The form itself is reasonably straightforward, so I won't go through it in any detail. The final slide, again, I'll leave for everyone to take away and read through at their own pace. Really, given the time constraints that you're working to for the first 2 fortnights, which end on the 30th of April, the priority is to ensure that you assess the eligibility, ensure you get the nomination forms, make your payments, and ensure you enrol by the 30th of April. So that's the end of the technical content. So I'm going to hand back now to Andrew to facilitate the Q&A for any of those questions that might have come through during the technical presentation.
Terrific. Thank you very much, Sam. We've got a number of questions that have come through. I will put the first one to Will. Can you let us know what a supply is, Will?
Yeah, good. Thanks, Andrew. That's a really good question. So this is obviously fundamental to working out your GST turnover for the period. Supply is actually a concept that is driven in the GST Act, but although there are some modifications to it under the JobKeeper scheme, for example, for non-for-profits to take into account certain monies that they may receive, which may otherwise not normally be considered a supply. But if we think back to the basics of a goods and services tax concept, it's going to be a supply of goods, a supply of services, as well as a broad range of other things, which is an inclusive concept. So I'm not sure if Sam wanted to add to that, but effectively it is a very broad definition.
Yeah, it is a very broad definition. The technical definition in the GST Act is a supply is any type of supply whatsoever. So it can be obviously a supply of goods, supply of services, supply of real property, but even intangibles like IP, licenses, even to the point of what's called the supply of an obligation. So you agreeing not to do something can be a supply in itself. So it is an exceptionally broad definition.
So really anything that a business sells is going to be caught up as a supply.
Yeah, and quite often the starting point is if you're receiving cash in the business, it's usually, there's no such thing as a free lunch. So, you know, it's probably easier to say, I've done something for that cash. There's usually something given up for it.
And can you just expand on that a little bit? And what does a supplies not connected with Australia mean? Should the export be included?
Exports should be included. So usually, and it's broken out into one of three buckets. So where what you're supplying is goods, a supply will be connected with Australia if the goods themselves start in Australia, which is why supplies of exports are connected with Australia. But if you import something into Australia, that supply is not connected to Australia.
Okay.
Supplies of services, if the business is located in Australia, the service will be connected with Australia. So generally speaking, when we're talking about Australian resident businesses, their suppliers are going to be connected with Australia.
So got a question here that will probably be applicable to a lot of people. And Tracy, if you could help with this one. Can you clarify a 17-year-old dishy who usually earns $100 a week, worked for us for 18 months would be entitled? So that's the lower paid casual who meets the 12 months definition. What are they entitled to?
Okay, so if they meet the entire definition of a long-term casual, so being employed for 12 months or more on a regular and systemic basis, then they will be required to be paid their $1,500 per fortnight before tax, irrespective of what their usual earnings are.
So there's no reference to what they were earning previously. They're just entitled to $1,500 per fortnight now.
That's right. The minimum payment or the minimum wage is actually set down under an amendment to the Fair Work Act, and that has been changed so that employers can meet the wage condition that is under the rules. So yeah, unfortunately, casual and part-time employees who usually earn less than $750 a week or $1,500 a fortnight before tax will need to be brought up to that minimum amount for the requirements to be satisfied.
Terrific. And also, Tracy, I'll ask you, the question is, one of our instructors, a sole trader, has been told as he hadn't done his 2019 tax return, he's ineligible. He has now done his tax return via a tax agent, but was told that he wouldn't be able to get it. Would there be any lenience from the ATO re this, and what would you recommend to do?
I'm not sure where the advice has come from that he's not eligible, because it would depend on whether or not he had an extended lodgement period for his 2019 return. I believe that there is some leniency where the 2019 return wasn't lodged before the 12th of March, but the taxpayer was on an extended agent lodgement program. So that might be something that needs to be referred back to the ATO for clarification.
Terrific, thank you. And Sam, a question in relation to GST turnover. Last year, our company invoiced nearly double than what we did this year, but as we're on sales rather than accruals basis, our GST income last year for April was less than what it is this year. Does this mean we are not eligible?
So you still need to look at it on a period by period basis. So if last year you were on a cash basis, I take it what we're saying is last year you were on a cash basis of reporting for GST purposes. You may have invoiced but not collected the cash. You could say use the March 2020 period, the month, to do the testing. You could use the April, or you could in fact use the entirety of the June quarter, so the April to June quarter, and do the comparison between April to June 2020 to April to June 2019, both on a cash basis. But the point I made was if you're on a cash basis, you look at your prior period, so your 2019 period on a cash basis, but you can also look at 2020 either on a cash basis or an accruals basis. And so if you're expecting to issue a whole bunch of invoices between now and say the end of June or the end of April, but not get paid, then you can, I guess, pick and choose which way you want to go. Do you want to use a cash basis and estimate how much cash you're going to receive between now and the end of the period, or do you use accruals basis for how much in terms of invoices you can issue? So I think on that basis, there is a bit of flexibility. So I certainly wouldn't rule out that you could be eligible. No, I think it's just a matter of working through the tests.
Okay, so if I could summarise that, if you report GST on an accruals basis, you have to test on an accruals basis. But if you report GST on a cash basis, you can choose to either test on cash or on accruals.
Only for the projected turnover.
Only for the projected turnover. Terrific.
Yep.
Thanks for that. Now, another question for you, Sam. If you choose quarter ended 30 June, can you still get paid in May for the April JobKeeper payments?
I might have to defer to Tracy and Will on that question. The mechanics of actual payment aren't my specialty.
Okay. Will or Tracy?
Can you just repeat that, sorry, for us, Andrew, what the question was?
So the question is, if you choose quarter ended 30 June, can you still get paid in May for the April JobKeeper payments? So I think there's an assumption there that the enrolment is made in May,
Yes.
using June quarter projections. What happens to those April JobKeeper payments in that situation?
Okay, so just in terms of the timing of it, so if we're looking to enrol for the first 2 fortnights, so these are the fortnights beginning the 30th of March and the following fortnight after that, then we have an extension to meet the minimum wage condition of $1,500 until the 30th of April. Beyond that, there has been no extension, so you would need to meet the minimum wage condition in the relevant fortnight. Beyond that, I'm not sure if there's a second aspect to that question or whether that addressed it.
Now, I think we're looking at is that, and it ties in probably with this next question, is can we still enrol in the JobKeeper scheme after 30 April, as expecting turnover to decline in May and June? So once you become eligible, what happens to those previous fortnights that you hadn't enrolled?
Yeah, sure. So once you determine an enrolment point, so if you're not eligible to enrol for the months of April, then you completely miss out on any JobKeeper support for those fortnights, and you'll only be receiving JobKeeper from the point in which you commence to be enrolled. Now, the enrolment form process, though, that's the question whether or not that needs to be in by the fortnight or not, and typically it needs to be in by the fortnight, the exception being the first 2 fortnights, given we're already towards the end of April and they've given us until the end of April for that.
Okay, thank you. So, Sam, a question for you. What if I'm a sole trader who registered in July 2019 and is not registered for GST? To use alternative test method, what should I use to prove turnover decline?
Using the basic test or the alternative test, sorry?
The alternative test.
Yeah, so so if you weren't in existence at the time of the test period, so let's say your test period that you're looking at is April 2020, it'd be one of the first 2 tests that you're looking at. So you could either use the average of your monthly turnover since you commenced business, so from July all the way through to March 2020. So the average turnover for those periods would be the comparison against April 2020, or if, like most startups, you start fairly slow and then you're working your way up, you could use the second alternative test, which allows you just to focus on the last 3 months prior to the test period. So in that example, what you're comparing is April 2020 against the average of January, March, and February 2020. And if that meets that 30% decline, then you'd be eligible for JobKeeper.
All right, thank you. Tracy, I'll ask this question to you. What is suggested for a closely held employee who previously has taken a quarterly wage to coincide with activity statement lodgement? So I'm assuming if they're taking a wage, they are taking PAYG, so a small company, and they're taking a quarterly wage.
That's a good question, Andrew, and I don't think I have an answer. It's something that I would probably need to come back to after looking at the ATO guidance.
Thank you very much. And I will mention, any of our questions that we aren't able to answer, if you go to the RSM coronavirus resource site. That's rsm.com.au/coronavirus. We have a query box in there. You can enter your query in there and someone will get back to you. Will, we've got a question here. A school has funding per child. Is the funding part of the supply figures for the purpose of turnover?
This is a really good question, especially if we're receiving term or semester fees and they come in as a lumpy amount, isn't it? So I think there's a lot to be thought about that. I will get Sam's opinion on this as well, but I think it will be included, and obviously it will be referred to the particular month or the quarter, depending on how you're assessing it, in which those fees are raised.
Yeah, I think that's right, Will. So if you go to the definition of GST-free supplies, one of those GST-free supplies is in respect of school fees. So even though no GST applies to school fees, it's on the basis that it's GST-free. And as we saw in the box around what isn't included in turnover, GST-free supplies are included in turnover. So as Will said, you would include it in both your current and projected turnovers. The exact period in which you include it obviously depends on which period you're testing, but also whether you're accounting for GST on a cash or an accruals basis.
Thank you. Tracy, in terms of making the first fortnightly payments before 30 April, does that apply to eligible business participants, or do we not have to pay them but just enrol assuming they satisfy the eligibility requirements?
My understanding, and Will can correct me if I'm wrong, is that there's not the requirement to satisfy that minimum wage condition for a business participant. Is for eligible employees, but not for an eligible business participant, because the amount is actually paid to the entity, not the nominated individual.
Yes, I agree with that. So if you took the example of a partnership, and obviously a partnership cannot employ the partners because you can't employ yourself, then in that particular case, one of the partners might be the business participant that the partnership uses to get the JobKeeper, but the $1,500 per fortnight just goes into the partnership, and then the partnership doesn't have any obligation to pay it out to that particular partner. It can just use it to defray the expenses of the partnership. And just to extend on that too, Andrew, if I may, I know that's a topical point around directors and whether or not they are business participants or employees. So that will really come down to whether the director is an employee for ordinary purposes. So some directors are acting in a non-executive capacity and others are acting in an executive capacity. So it'll determine whether or not they're an ordinary employee, will depend whether they get that type of concept. And if they're not an ordinary employee, then they may be an eligible business participant.
Excellent. So, Will, while I've got you, a couple of questions on the mechanics here. Have enrolled on the ATO website but hasn't confirmed us as eligible. At what point are we confirmed as eligible?
So I think so. They're saying they haven't got anything back from the ATO, I think is what the point they're saying. Yep. Well, I think as soon as you've submitted your form, you're in the system, unless there's been an error in the form. But if the form has been accepted, I suspect that won't be the case. My understanding, and again, Tracy, I'll see if you had any alternative views. My understanding is as soon as the form has been lodged successfully with accurate data, then you're enrolled. It's effectively correct. An election.
It's self-assessment.
Yeah.
I will note though, there are bugs in the ATO forms. So particularly for sole traders with employees, if you're trying to, if this impacts anyone in the audience, if you're trying to lodge and you're getting an error saying that you're ineligible because perhaps you are employed by an entity yourself, might need to call the tax office because there is a known error with that form. So just something to keep in mind. But generally, if the forms are working, if you submit the information, you're in once it's lodged.
Yeah, just on that point, I did have a client who thought they'd registered for the JobKeeper scheme, but all they had actually done was just register their expression of interest, which was the one that was open a week or two ago. So just make sure that you're actually registered for the scheme, which is the form that was open as of Monday and not the one of 1 or 2 weeks ago.
Yeah, that's right, because there was the original expression of interest, which they called register your interest. Then there's a online enrolment form that is available either through the business portal or through the tax agent portal. And then there'll be another step that opens from the 4th of May where employers are then required to provide more detail into the specifics around their employees.
Okay, got a couple of turnover questions here which raise good points, and we'll bring both of them up as once because they're similar type of questions. If before 30 September we become on par with previous year's turnover, less than 30% down, does the JobKeeper stop? And also, if my business meets the decline in turnover test for the month of March 20 versus March 2019, but do not for the month of April, do I qualify, and am I required to retest each following month?
So the answer to that is once you're in, you're in. So you only ever need to satisfy the decline in turnover once. And so if, for instance, March, you meet the decline in turnover test, but in the month of April, your decline is only say 20%, you are still eligible for the scheme. So you never get kicked out of the scheme once you become eligible. You don't, in fact, need to retest your decline in turnover for April. What you do need to do is every month, so the 7th of the following month, is to send the Commissioner your decline in turnover or your turnover figures. That isn't for the purpose for the Commissioner to recalculate your turnover. It's for data collection purposes, just to see how businesses are improving, hopefully, over time. But I guess to go back to the question, you don't need to keep retesting it. And the other point actually to note here is that when you're looking at, say, April or May or any projected turnover, you're actually basing it on an estimate, and again, reasonable estimates. And if it turns out the estimate isn't quite matching the final set of numbers, that's okay. So in theory, your actual decline in turnover may never get to 30%. You just needed to have projected a decline in turnover of 30%. So that's why it's so important to document your assumptions that have underpinned your projections, because, as I said, potentially you may never have actually gotten to the 30% decline required.
Okay, thank you very much. Another question for Tracy. At what point will our employees' eligibility be confirmed? Do we need to pay them first and hope we get all the subsidy back?
It's a good question. Again, it comes back to self-assessment. So there is an onus on the employer and the employee to ensure eligibility of employees. And so the employer is required in the first instance to identify eligible employees, and that might need assistance from an advisor if there's, casual employees or, employees that are on special subclass visas. Once the employer has determined that the employees are eligible and that employees have agreed to be nominated and they've confirmed their eligibility, then the minimum $1,500 payment needs to be made. There won't be any confirmation of eligibility from the ATO, so it is important that employers and employees understand, that they do actually, consider the eligibility criteria, because if they get it wrong, there is a risk that they'll be ineligible for that particular employee, and the employer and employee will both be jointly and severally liable to repay the amount.
Okay, so on payroll, if we have a monthly payroll, does the guidance imply that in August we need to pay the whole month by the 2nd?
I'm not sure about that one. Might need to refer back to the payment periods that are for the JobKeeper fortnights.
Yeah. So for those who pay on a monthly salary and not fortnightly, can they continue to pay monthly, or do they need to switch to fortnightly payments to qualify for the JobKeeper scheme?
They can continue to pay monthly. There's no requirement to change the payroll reporting periods, but they need to ensure that they have made the minimum payment required over those 2 JobKeeper fortnights within the month.
All right, terrific. Well, we've got time for just one or two more questions. We are getting a lot of repeat questions there, but probably one important concept: do we record the JobKeeper payments coming in from ATO as other income? I'm happy to open to that to anyone on the panel.
Well, I think that's appropriate. So we haven't actually seen any specific accounting standard guidance yet as to whether or not it's meant to be a reduction in salary or otherwise accounting for in a reduction in cost of goods sold, for example, if you've got employees working in that space. But for the moment, I think that the preference is to report it as other income. But I would very much, if you are a reporting entity and needing to prepare financials in accordance with accounting standards, I do think we're waiting for the Accounting Standards Board to give us some guidance on this particular issue, either as an urgent issues group point or not. But I think in terms of if you're a small entity just doing your general books, I'd be certainly treating it as other income.
Well, thanks for that, and thank you to Sam, Tracy, and Will. We've come to the end of our time for this webinar. As I said earlier, if you do have further questions, check out the RSM coronavirus website at rsm.com.au/coronavirus. There's plenty of information you can get there, and you can also contact us through that site to handle any remaining queries that you may have. Thank you very much for your time and attendance this morning, and we really hope that was helpful to you.